All the media I'm seeing about the Fed meeting is talking about the wrong thing. Everyone's talking about the Fed cutting rates. Yeah, they cut 25 basis points. No, it's not surprising. What was surprising is what they're doing with mortgages, and I don't see anyone talking about it, so we have to. I'm a relatively small channel, and I'm new around here, and so I'm starting to build out the threads of ideas that I want to discuss. One of the ideas that I want to discuss is something that's been going on this year, and specifically with the current administration. They have the right idea here in that the government can't have rates above 4% for a long period of time because they want to borrow a ton of money. And this isn't a partisan issue. Both parties borrow tons of money. The current administration is trying to borrow a lot. They've already gone through 1.6 trillion this year. Our total outstanding debt's now at 38 trillion. Financing this is very expensive. We spend more on interest payments than we do on veterans and education combined. So, the government wants to borrow. They don't want to raise revenues. They want to cut spending, but you can only cut so much spending. A lot of it is mandatory. It's required spending, and they can't cut it. So we can't cut our way out of the deficit. And the people in charge don't want to raise revenues to get out of the deficit, or the ways of raising revenues are not enough. Yeah, tariffs brought in 50 billion this year. That's great. But our deficit is in the hundreds of billions. Our deficit per the quarter is $1 trillion. We had to do $1 trillion of borrowing just to finance the last 3 months. You can't put export controls and tariff your way out of that. There is a much bigger monster to keep at bay. So interest rates must come down, and specifically not short-term interest rates. We're talking about the Fed lowering interest rates, but that's not the key interest rate to watch. The key interest rates to watch are the 10, 20, and 30-year treasuries. This is where the government can lock in very long-term low rates when they have them. Historically, these rates have been low. We've lived in ZIRP, zero interest rate policy. In ZIRP, the government can essentially borrow risk-free. They end up borrowing at a rate that is above inflation, but only reported inflation, not actual inflation, the inflation that we all feel day to day. They're basing that on CPI, but CPI is an imperfect metric. We talked about how they're guessing 30% of it last week. So the government needs low interest rates, but the 10, 20, and 30-year treasuries are not controlled by the Federal Reserve. The Federal Reserve only controls the overnight rate, the rate you can get tomorrow. And of course, when they move that rate, the whole curve shifts. We've talked about the yield curve before, where you can plot the various maturities of treasuries along their rate path. And one of the things we see in the yield curve is that historically, when the Fed funds rate drops, so does the rest of the curve. So this is what we've been seeing over the last couple months. Every month, the whole curve moves lower. And this is partially to do with the Fed lowering rates and telling everybody that they're going to lower rates. They are intentionally predictable. They want us to know where it's going so that we price in lower rates on the long end of the curve. There's another component to this: open market operations. The Fed is able to print money. I mean, literally, they're able to generate dollars that didn't exist before. They're able to use this to buy assets. Now, traditionally, they've bought two kinds of assets in order to stabilize the markets. They buy treasuries and they buy mortgages. At this meeting on the 29th, Powell gave an interesting remark about the balance sheet, and specifically about what they're doing with mortgages. I'm just going to play the clip here, and then we'll talk about it.
Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet, and will reinvest the proceeds from those securities in treasury bills, furthering progress toward a portfolio consisting primarily of treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of treasury securities.
So Powell says that their balance sheet holds two assets, right? Treasuries and mortgages. These mortgages are mortgage-backed securities. They're big bundles of mortgages. They're guaranteed by Fannie Mae or Freddie Mac, the large quasi-governmental mortgage lenders. And so the Fed is buying these to ensure that there is always demand for mortgages. Fannie and Freddie traditionally operate as a kind of an economic backstop to ensure that even in the worst economic conditions, we can always guarantee mortgage loans will be good investments for banks. And the Fed guarantees demand for that even if the banks don't have it. They can buy those mortgages off the open market. But Powell says they're not going to do this anymore. They're not going to dump the stock, but they're letting it roll off. As these mortgage-backed securities mature, all of the reinvestment is being made into treasuries. He says they're basically going to a 100% treasury portfolio from a currently mixed portfolio, but a huge amount of mortgage-backed securities. Most of them they accumulated during the pandemic. Okay, so what? The Fed's buying treasuries. Great. But remember, the Fed has a vested interest because it's controlled by the government. And I think the current Fed feels this way less so than the next Fed will. A new Fed chair will be appointed in May 2026, or whenever the Senate approves them. My money's on Governor Waller. That next Fed chair will be clued into the Treasury's plan to try and borrow a tremendous amount while keeping the government afloat. That person knows the Fed needs to keep rates as low as possible, and it's not just the Fed funds rate that will do that. We're still dropping the Fed funds rate. I still think we probably have 75 basis points more to go from here, likely over the next 6 months. But I think this shift away from mortgage securities is because the Fed believes that to control the long end of the curve, they're going to need more ammunition. I think they did this scenario where they try and control interest rates through buying treasuries to force interest rates down on the long end of the curve so that the government can borrow cheaply. And they found that they didn't have enough buying power. How do you get fuel? You repurpose the mortgage securities. If you're dumping the mortgage-backed securities, the housing market will sort out itself. Fannie and Freddie are still lending, and the Fed isn't worried about the housing market. In fact, the housing market's at all-time highs. And that's despite a 6% mortgage rate, by the way, but that's another story. So it's clear to me now more than ever that the Fed intends to do yield curve control. They intend to oppress the bond market and to force yields lower from here. If you're somebody who is thinking about buying long-term treasuries, like physically owning a 20-year bond, you're likely at and already past peak rates. I've been calling out peak rates on Seeking Alpha for a year and a half now, and we're at the point now where if you're locking something in, like a long-term CD or a long-term treasury, now's the time to do it. Now for traders, this is a different story because now we're just looking at duration. All I want is to lever the way that I get into rates falling. So before we get into this for traders, we need to understand duration. Duration is a measure of a bond's sensitivity to interest rates. Duration and interest rates are negatively correlated. So the more duration something has, the more it will gain when interest rates drop, and the more it will lose when interest rates rise. See the TLT chart for an example of this. TLT is the long-term treasuries, 20-year treasuries. And so they have a ton of duration. I think the duration of the fund is 17. If you're betting on interest rates coming down, then you're looking at this chart thinking, oh, this is the ride back up. I agree. But TLT is not convex enough for me, and options require too much timing for me currently. I'm not sure or so sure on the time frame of this, and a timeline of 18 to 24 months just doesn't seem like a good optionable value right now. So instead, I am looking at institutional options, in this case, RFIX. The RFIX ETF is a fund that owns swaptions on the 10-year treasury. So these are 10-year call options. They're called swaptions. They have some features of options, some features of swaps. It will dramatically benefit from interest rates falling. So its duration is close to 43, which means it is incredibly convex and incredibly asymmetric to where we are in rates. Rates cannot go up from here because it will bankrupt the government. And the Fed is going to ensure that rates are going down. They're telling us month after month, slowly and slowly, that they have more and more tools available to them to lower interest rates. In the next 10 years, interest rates will likely be what they were in the last 10 years, which is under 2% on average and negative in a real sense. Inflation will likely be above the 10-year treasury rate, or at least real inflation, not what's reported in CPI. If this is the case, then RFIX should gain tremendously this force of the yield curve down by the Fed. It creates a put for this trade and a downside floor. Yields cannot go very high above where they are now. Even if we had runaway inflation again, yields will go back up to 5% like they were before when we defeated inflation last time. And that's not that far from here. But on the other sense, if yields fall back to 0 or back to 1%, where I think they're headed in the next 18 to 24 months, then RFIX is the play here. It allows you to hold convexity, meaning you are able to bet a little bit and get a lot of exposure. And it allows you to benefit disproportionately from the duration trade over something like TLT. I want to caution people out here. I don't usually shout out tickers in these kinds of videos, but I'm trying something new where I explain the action that one can take behind this. It's one thing to be doom and gloom about where the Fed's going and how the market's being manipulated, and that's mostly true and unfortunate, but there has to be something we can do about it. So I thought this might help. Hey, if you found this useful, if you thought any of the charts were interesting or my ideas provide their own convexity, then you should consider subscribing to my newsletter. There's a link down below. I publish once a week on Sunday straight to your inbox, full of charts and insight. It's called the Macro Obsession. And while you're down there, go ahead and like and subscribe to this video too. See you next week.